What would you say if I told you that the bank doesn't just make money from loans, they make money from your money, but you could do the same thing and ultimately you can become the bank? This is a strategy that the wealthy have been using for years. They borrow cheap, earn high, and keep the difference, called interest rate arbitrage. When this is done right, you can become your own bank. When this is done wrong, you can lose everything. So make sure you pay close attention to how the strategy works so that you can win the game of wealth. Now, what's the problem? Most of us have only been on the side of this transaction, maybe as a customer. We either have deposits in the bank, they're giving us a measly 0.5% or 1% to keep our money there. They then take that money and go invest it and do whatever else they want, and they pay us back that 0.5% or 1%. Or maybe you borrow money from the bank and you pay the bank 5-6% in interest, right? Or maybe even 9%. And then they take that money and then they make more than that, right, off of your money. So you're funding their operation for them to become their own bank, but you can do the exact same thing. See, the truth is, money never sleeps, it flows. You make deposits, the bank takes that money, they lend it out to other people. People take that money that they got, they buy real estate, they buy cars, they invest in their business, they take that money goes back into the bank, and the bank keeps getting a piece of the cycle. Now, the question is, how can you do the exact same thing? Don't believe me? Don't take my word for it. The bank literally borrows from the Federal Reserve, let's say around 5%. Then they're going to lend that money back to you at 7 to 9%, and they get to keep the difference. They're leveraging money that isn't theirs to begin with to be able to profit off that money, and that is the essence of interest rate arbitrage. Investors get to take advantage of a similar strategy, and this is where you come in and how you can benefit as well. So investors can take their portfolio, borrow against that portfolio, let's say at maybe 5 to 6%, but that equity portfolio might be generating 9 to 12%. So the first win is that the money that I'm borrowing, which isn't going to be the total of the portfolio, I'm already getting a spread between the interest rate and the rate of return of that portfolio. But the real magic happens in what I do with that money. So I'm going to take that money and I'm going to not just reinvest it back into the portfolio, which I could, but for me, that's a little bit of a concentration risk. I want you to invest in a non-correlated asset or something else. Take that borrowed money and then go invest in real estate. Take that money, then maybe go buy a business that you own but do not run. And so now you have another asset that's producing cash flow. You then can take that cash flow, reinvest it back into the portfolio so it can further compound, and also pay back your loan interest and still have a spread to keep for yourself. So let's break that down. So now that my portfolio is growing, I also get to mitigate my risk because you're borrowing based upon the value of your portfolio. So now that you've reinvested money back into the portfolio, the amount or percentage that you're borrowing is lower than when you first started. On top of that, because of the portfolio growth, it also drives down the risk. And this just gives you more ability to rinse and repeat this strategy so that you can build more wealth 3 times faster. Again, I never want you to exclusively take my word for it. So let's look at billionaires like Elon Musk. When he bought Twitter, now known as X, he borrowed against the value of his Tesla shares to be able to acquire that company. He didn't have to sell his Tesla shares. And on top of that, because he didn't sell those shares, he did not create a taxable event, all while still owning the asset that got to grow and continue to appreciate. That is the real wealth cheat code. Imagine a world where you have an asset, it gets to grow uninterrupted, you get to borrow against said asset, take that borrowed money to go buy another asset, and then on top of that, you don't have to pay any taxes. This is how the wealthy stay wealthy and how the rich get richer. I personally like to call this strategy the financial freedom flywheel, because when you do this, it just sets off a trigger in motion that allows you to accelerate what you're able to do. So it all starts with your initial asset that you want to leverage. For me, it's going to be a globally diversified portfolio of stocks and ETFs. Once that is established, then what I'm going to do is I'm going to identify different assets that I want to acquire. For example, I might want to buy a real estate property. And so at that point, then I'm going to borrow against the value of that portfolio. Once I borrow against that portfolio while it's still growing and thriving, uninterrupted, without any taxable event, then I'm going to take that money and deploy it to the new asset. But in order for me to deploy it to the new asset, I would have needed to do the research to validate a couple of things. Number one, I'm borrowing against the value of my portfolio at a certain percentage. I want to make sure that the cash flow that I'm receiving from the new asset is going to far outpace the loan interest that I have to repay and what it costs me to carry that debt. Because if I'm not making margin on what I'm borrowing, then this strategy doesn't work. It's no different than someone who has a credit card and they're chasing points, but they're not paying the balance off in full, and now they're not getting the benefit of it, right? What's the benefit of getting these rewards points when you have a 25% APR? So this strategy has to be done right. Then we take that cash flow, we reinvest it back into the portfolio, and taking a small portion of that obviously is servicing the loan interest. When that money goes back into the portfolio, it's going to compound at the same rate as the original portfolio, and we're putting more capital in it to supercharge it, and now that becomes our bank. Because while we put money in the regular bank, when the regular bank, we take the money out, the money's gone. We put money in our portfolio, we borrow against it, the money stays there, it grows 10 times more than it will at the bank, and I still get access to the capital to do whatever I want to do. Many people leverage this strategy to escape the tax code in its entirety, known as a strategy called buy, borrow, die, where they buy quality assets, they borrow against them and use the borrowed capital or borrow money to live their lifestyle, and then when they die, they use the life insurance proceeds to pay off the outstanding loans. Their heirs will inherit the assets tax-free, and they'll receive a step up in basis. So there's many ways that you can cut this cookie, but the most important thing to understand is we have to leverage our own money the same way the banks leverage our money. Because when we take control of it, we get the benefit of being the bank instead of letting the bank use us. If this strategy opened your eyes, then make sure you subscribe to our YouTube channel and comment below. Let me know that you want to see more videos like this, and share it with a friend so that we can continue to build wealth 3 times faster than traditional financial advice. Thank you for tuning in to another episode of Financial Freedom Fastlane. And remember, the quicker you get to your dream life, the longer you get to live it. Peace.